Thanks for inviting me, Lori. It's a pleasure to be here. I want to talk today about bank capital requirements, which are much in the news. You're probably hearing about the fact that many of our world's largest banks are potentially insolvent. Some, of course, have recently been insolvent. They got bailed out, many of them by taxpayers, and a lot of economists are trying to figure out what is a better way to make sure that banks are adequately capitalized, because it doesn't seem like we've been very successful at that so far. The first point, of course, which is very important for those of you who've taken advanced corporate finance, we don't really ask this question about other firms. We presume that firms responding to market forces will typically figure out what the right amount of equity relative to debt is to fund their activities. Nobody's talking about putting a capital requirement on General Foods. General Foods presumably holds the right amount or close to the right amount of capital, and we don't particularly talk much about that as a policy issue. Why do we do it for banks? Well, it's pretty simple. You don't have to get much farther than the fact that banks' debts are protected by the government. So as soon as you have the debts protected by the government, there's going to be an incentive to overdo it with the debt relative to equity, to target, if you like, an unusually high default risk, especially when you know, and because you know, that someone else is bearing the downside. And so, not surprisingly, banks left to their own devices voluntarily will not choose a high enough capital ratio, that is a high enough ratio of equity to debt to absorb losses, because their debt is insured, and therefore their debt holders don't punish them for choosing inadequate capital. So that's the problem. So what's the solution? Well, the solution is for regulators to set minimum capital ratio requirements, that is, minimum ratios of shock absorber, let's call it capital. Roughly speaking, it should be equity or something that will become equity in time to absorb loss relative to the protected debt. So what you want to make sure of is that you're making that bank hold enough, issue enough capital, enough equity, so that when losses happen, those losses are not large enough to cause taxpayers to have to fund the protected debt from taxpayers' funds rather than from the assets of the bank. Sounds like a pretty simple problem. Figure out what risk is. Figure out what an adequate amount of capital would be, and require it. We've got some problems, though. Measuring risk and measuring capital. So even if we could agree on some model that would tell us for a given amount of risk what the right amount of capital would be, and in fact, we have a lot of models like that, we have the problem of observing credibly the risk and observing credibly the capital. And those have been the problems that have been plaguing us. Let me give you a couple of examples about this. First, in terms of an example of inadequate capital budgeting. Citibank, if you looked at the market value ratio, so a credible measure of bank capital, the market value ratio of Citibank's equity relative to its total assets in April of 2006, it was about 13%. If you had looked at Goldman Sachs on that same date, it would have been about 8%. So you might look at that and say, well, that means Citibank has a much greater capacity for absorbing loss. Except what we learned in the crisis was Citibank's risks were so much higher that even that higher capital ratio wasn't sufficient to absorb all of the risks that Citibank was taking. So it turned out that Goldman Sachs' 8% market value ratio in April 2006 was low relative to Citibank's. Was high relative to Citibank's on a risk-adjusted basis. And then the second problem, so the first problem is being able to measure risk. We weren't measuring risk very well. The second problem is measuring capital. When Citibank failed in December 2008, Citibank was showing a regulatory capital ratio of 11.8%. So obviously, and that it was true for all of the banks that failed, that they had very high regulatory capital ratios. In other words, Regulators weren't recognizing that much had happened in the way of loss. Now, Citibank's market value of capital ratio had fallen to less than 2% at that time. And in fact, over the whole period from April 2006 through to December 2008, there was a fairly steady decline of that market value ratio. In other words, the world knew that Citibank was losing money, and it didn't happen overnight. It happened fairly steadily. They lost about 30% of their capital ratio before the end of 2007. But the regulators didn't recognize that loss. So what's really going on here? What's really going on is it's not their money. That is, it's neither the bankers. When the bankers cause losses to taxpayers, the bankers don't pay the bill and the regulators don't pay the bill. We pay the bill. And we're not the ones running the regulatory regime. And bankers and regulators both have strong incentives to avoid the recognition of loss. Politicians lobby very hard on regulators really not to recognize loss because the consequences of loss recognition could be very embarrassing for them. It might cause banks to have to contract credit, for example, in response to their losses, which could cause a recession. So the world over, time and time again, we've seen regulators basically forbearing. That's a polite word for lying about losses. Bankers also have a polite word for lying. It's evergreening. So whenever you hear a three-syllable word in finance, typically it's a synonym for lying. And that's especially true when you look at regulation. Okay, so there are lots of fixes that people are looking at right now, and I have several papers looking at some of these, but I'm only going to talk about one today. So one dimension to try to fix is to measure risk better, and there's a lot of work going on that. Another dimension to fix is to think of other kinds of requirements, like cash requirements on the asset side. Because, you know, the difference between capital is if you lie about capital, you get patted on the back. But if you lie about how much cash assets you're holding, you go to jail. And so many of us have been talking about how cash reserve requirements could be a very important contributor to prudential regulation on top of capital requirements. So there's some interesting new things happening. But the third one is perhaps the most interesting. And that's an idea of coming up with a different structure of capital that will be more dynamically responsive to losses, and that won't depend on the voluntary recognition of losses either by bankers or by regulators. And the idea here, which I'm going to talk about today, is to restructure capital to have two parts. One part, and let's say of roughly equal parts. 10% of assets in the form of equity and 10% in the form of something called COCOs. Yes, I know it's November and it's nice to think about COCOs in the cold weather, but these are different. These are contingent capital certificates. They're basically debt certificates that convert to equity capital when the market value ratio of equity hits a sufficiently low trigger. So when the bank starts to get anywhere near, and we're going to propose in the paper that Dick Herring and I have written, a fairly high trigger. We want to set the trigger at about 9% market value equity ratio. And then when the bank starts to get close to that, let's say about 10.5%, the banker is going to start worrying because if it hits the 9% trigger, all of its COCOs would convert to equity. Now, we're going to set up these debt conversions to be so dilutive of stockholders and managers that the managers would never want that conversion to take place. It's very simple. How do you make it dilutive? Well, you just make the conversion take place in a way that disadvantages pre-existing stockholders. And so you create a sort of Damocles, if you like, that makes the managers of the banks want to avoid conversion. So when they're going to target an equity ratio, let's say around, on average, about 12%. And when the equity ratio starts falling down to about 10.5%, what are they going to do? Voluntarily issue equity into the market. I had breakfast with a vice chairman of a large financial institution in the summer of 2008. And I said to him, why aren't you issuing equity? You know, the markets are open. Everybody's, selling equity. It's not hard to sell, and you desperately need it. And he said, well, we don't like the price. Of course he didn't like the price. Bear Stearns had just been bailed out. It showed that on the downside, you're protected. Why not wait, hope for the best, and issue into a more favorable market than the summer of 2008? Now, if there had been a COCO conversion trigger hanging over his head, he would have had a different feeling about issuing equity in the summer of 2008. He would have wanted to issue it because he was worried about the dilution costs of issuing a little bit of equity into the market. But those dilution costs would have been dwarfed by the dilution costs of having a major conversion of a very large amount of debt into equity on favorable terms for debt holders. And so whenever I think about this proposal, I think about the picture of him over breakfast in the summer of 2008 explaining to me why he didn't want to issue capital. Now, some bankers have termed this proposal an electric fence. And what I say is they're getting it. That is exactly the idea. An electric fence that as they back up, they feel they have nowhere to go but to issue some equity. What we want is for equity to be replaced on a timely basis. Instead of Citibank allowing its equity ratio to fall gradually over time from 13% to less than 2%, when it hit about 10%, they would have gone back into the market, and they probably would have kept that equity ratio higher. And by the way, we never would have had a liquidity crisis if the banks hadn't allowed their counterparty risks to go up as a result of the declines in their equity. And so this is, I would argue, a formula for stabilizing the banking system, for ending the too big to fail problem, and for making capital regulation dynamically credible. That's the idea. Thank you.